Preparing for a financial analyst at Cox interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Tell me about yourself and why you want to become a financial analyst at Cox. I have built my foundation through accounting coursework, financial modeling, and projects where I translated data into recommendations. I enjoy understanding what drives performance, not simply producing reports. Cox interests me because its businesses require analysts to connect operational activity with financial outcomes, while serving customers and investing for the long term. I would bring strong Excel skills, curiosity, and disciplined follow-through. My goal is to become a trusted partner who explains results clearly and improves planning decisions. While answering, connect your education and analytical experience to budgeting, forecasting, business partnering, and Cox's customer-focused operating environment. Explain why the company's diversified businesses and emphasis on responsible growth genuinely interest you. Question 2. Why do you want to work for Cox? Cox appeals to me because it combines the scale of a major operating company with a long-term ownership mindset. That creates an environment where financial analysis can support sustainable investment, customer service, and operational improvement rather than only the next quarter. I am also attracted to the variety across Cox's businesses because it would strengthen my understanding of revenue, costs, capital spending, and performance drivers. The role fits how I work: analytical, collaborative, and focused on practical decisions. Make sure to cover Cox's broad operating footprint, privately held ownership structure, customer orientation, and opportunities to support decisions with analysis. Avoid generic statements. Link your motivation to the analyst responsibilities you are pursuing. Question 3. How would you build a monthly forecast for a Cox business unit? I would begin with actual results, historical seasonality, and the business unit's operating drivers. For revenue, that might include customers, retention, volume, pricing, or transactions. For expenses, headcount, vendors, usage, and planned initiatives. I would document assumptions, incorporate the latest operational input, and compare the forecast with budget and prior outlook. After reviewing variances with stakeholders, I would challenge unsupported changes, update the model, and summarize risks, opportunities, and confidence levels for management. In your answer, talk about historical trends, operational drivers, assumptions, seasonality, known business changes, stakeholder input, variance review, and forecast governance. Show that you distinguish a driver-based forecast from merely extending prior period results. Question 4. Walk me through how you would analyze a budget to actual variance. First, I would identify material variances against budget and isolate whether they reflect volume, price, mix, timing, productivity, or one-time items. I would validate the underlying data and compare the result with prior periods and forecast. Then I would discuss the drivers with the responsible business owner rather than relying on assumptions. Finally, I would explain the financial impact, whether it is recurring, and any forecast adjustment or corrective action management should consider. Be sure to mention identifying material variances, separating price, volume, timing, mix, and one-time effects, validating data, speaking with owners, and explaining whether the variance affects the full-year outlook. Question 5. What financial metrics would you monitor for a Cox operating business? I would monitor revenue growth, gross or contribution margin, operating expense performance, EBITDA, capital spending, and operating cash flow. I would pair those with business drivers such as customer additions, churn, retention, average revenue, transaction volume, utilization, or vehicle inventory, depending on the unit. The key is connecting the metrics. For example, higher customer growth may require capital investment, while lower churn can improve lifetime economics. I would prioritize metrics that explain performance and inform action. Focus on metrics relevant to the business model: revenue growth, customer or transaction volumes, churn, margins, operating expenses, capital intensity, cash flow, and return measures. Explain how operational metrics connect to financial outcomes. Question 6. How do the income statement, balance sheet, and cash flow statement connect? Net income begins on the income statement and flows into retained earnings on the balance sheet. The cash flow statement reconciles net income to cash by adding non-cash expenses such as depreciation and adjusting for working capital movements. Capital expenditures reduce cash and increase fixed assets, while depreciation later reduces earnings and the asset balance. Debt affects both the balance sheet and financing cash flow. Together, the statements show profitability, financial position, and actual liquidity. Make sure to cover net income, retained earnings, working capital, depreciation, capital expenditures, debt, and the indirect cash flow reconciliation. Demonstrate that you understand accounting relationships rather than memorized definitions. Question 7. How would you assess whether an expense variance is concerning? I would not judge the variance by size alone. I would assess materiality, recurrence, controllability, trend, and the reason behind it. A favorable variance caused by delayed invoices may reverse next month, while an unfavorable staffing variance could signal a persistent productivity issue. I would compare actuals with budget, forecast, and operational volume, then determine whether the full-year outlook changes. The conclusion should identify the owner, recommended action, and whether escalation is warranted. In your answer, distinguish favorable from unfavorable variances, recurring from temporary items, controllable from uncontrollable costs, and accounting timing from genuine performance. Discuss materiality, trend, forecast impact, and management action. Question 8. Describe an Excel model you have built or improved. I built a 3-statement planning model for a student consulting project that linked operating assumptions to revenue, expenses, working capital, and cash flow. I separated inputs, calculations, and outputs, used SUMIFs and XLOOKUP for structured data retrieval, and added checks for balance and missing assumptions. I also created upside and downside scenarios so users could test volume and margin changes. The model reduced manual updates and made the recommendation easier to explain to non-technical stakeholders. Be sure to explain the model's purpose, data sources, structure, formulas, controls, scenario capability, and business result. Mention tools such as XLOOKUP, SUMIFs, pivot tables, Power Query, or sensitivity analysis only where relevant. Question 9. How do you ensure accuracy in a recurring financial report? I start with a documented process identifying source systems, owners, deadlines, and required reconciliations. Before distributing a report, I check totals against the general ledger or approved source, review formulas and links, compare major movements with expectations, and investigate unusual trends. I use controlled templates, consistent file naming, and a separate review checklist. Finally, I retain support for material adjustments and ask a colleague to review high-risk outputs before management receives them. Focus on documented procedures, source reconciliation, formula checks, reasonableness testing, period cutoffs, version control, review evidence, and clear ownership. Show that accuracy comes from process design, not only careful proofreading. Question 10. Tell me about a time you explained complex financial information to a non-finance audience. In a project, our operations team questioned why profitability declined despite higher sales. I replaced accounting terminology with a bridge showing volume, pricing, labor, and material effects. The analysis demonstrated that growth came from lower margin work while overtime increased. I walked the team through the bridge, asked them to validate each driver, and agreed on 2 monitoring metrics. They adjusted staffing plans, and the next forecast reflected a more realistic margin outlook. The experience reinforced that clarity builds credibility. In your answer, use a concise situation action result structure. Explain how you simplified terminology, focused on business drivers, used visuals or examples, confirmed understanding, and changed the stakeholder's decision or behavior. Question 11. What is the difference between gross margin, EBITDA, and operating cash flow? Gross margin is revenue minus direct costs, so it highlights pricing, product mix, and delivery economics. EBITDA subtracts operating expenses before interest, taxes, depreciation, and amortization, making it useful for comparing operating performance but not equivalent to cash generation. Operating cash flow starts with earnings and adjusts for non-cash items and working capital, showing cash produced by operations. I would use all three together because margins explain economics, EBITDA shows operating scale, and cash flow tests liquidity. Make sure to define each measure, identify included costs and non-cash items, explain their uses, and note limitations. Avoid treating EBITDA as cash flow or assuming one metric answers every performance question. Question 12. How would you evaluate a proposed capital investment at Cox? I would clarify the investment's objective and identify incremental cash flows, including revenue, operating savings, implementation costs, maintenance spending, taxes, and working capital effects. I would calculate NPV using an appropriate discount rate and consider IRR and payback as supporting measures. Sensitivity analysis would test volume, pricing, timing, and cost assumptions. I would also evaluate customer impact, execution risk, and strategic necessity. A financially attractive project is not automatically the best decision if delivery risk is unacceptable. Be sure to mention strategic rationale, incremental cash flows, timing, useful life, maintenance versus growth capital, NPV, IRR, payback, sensitivity analysis, and non-financial factors such as customer experience or regulatory requirements. Question 13. How would you forecast revenue when historical data is volatile? I would first diagnose the volatility by separating seasonality, one-time events, customer mix, pricing changes, and data issues. Then I would forecast from operational drivers rather than applying a simple average. For example, I might model customers or transactions, retention, volume, and price separately. I would build base, upside, and downside cases, test them against recent indicators, and review assumptions with commercial leaders. The final forecast should communicate both the expected outcome and the uncertainty around it. In your answer, separate trend, seasonality, one-time events, and structural changes. Use operational drivers, multiple scenarios, external context, and stakeholder validation rather than blindly relying on a statistical average. Question 14. What would you do if a senior stakeholder challenged your analysis? I would first understand exactly which assumption, data point, or conclusion the stakeholder disputes. I would revisit the source, definitions, calculations, and time period, then test the alternative view objectively. If I made an error, I would acknowledge it quickly and correct the output. If the difference reflected judgment, I would present both cases and their implications. My aim would be a reliable decision, not defending a spreadsheet, so I would remain factual and collaborative. Focus on listening without defensiveness, clarifying the disagreement, checking definitions and sources, testing assumptions, acknowledging errors, and presenting evidence. Emphasize respectful challenge and a shared goal of reaching the correct decision. Question 15. How do you prioritize competing deadlines during a close or forecast cycle? I rank tasks by business impact, deadline, dependencies, and risk of delaying other teams. During a close or forecast cycle, I would secure critical source data early, create a visible tracker, and block time for review rather than using every minute for preparation. If priorities conflict, I would communicate the trade-off promptly and confirm sequencing with my manager. I would never sacrifice a key control silently, instead, I would escalate and agree on a practical solution. Mention assessing business impact, regulatory or management deadlines, dependencies, effort, and data availability. Describe early communication, a task tracker, escalation of conflicts, and quality controls for high-priority deliverables. Question 16. What is working capital, and how can it affect cash flow? Working capital captures short-term operating assets and liabilities, commonly receivables, inventory, and payables. If receivables rise faster than revenue, cash is tied up. If payables increase appropriately, cash is preserved. Growth can therefore consume cash even when the income statement shows profit. I would analyze days sales outstanding, inventory turns, and days payable, then identify operational actions such as better billing, collections, purchasing, or vendor terms. Cash forecasting must reflect those timing effects. Be sure to explain receivables, inventory, payables, operating cycle, and the cash impact of changes. Relate the concept to billing, collections, purchasing, vendor terms, and growth in a Cox operating environment. Question 17. How would you investigate a forecast that consistently misses actual results? I would perform a recurring forecast versus actual review by driver, not just by total variance. I would look for bias, stale assumptions, timing differences, missing data, model errors, and changes in customer or operating behavior. Backtesting would show whether a revised method improves accuracy. I would meet with owners to validate the operational story, update assumptions, and document the change. Finally, I would track accuracy and bias by line item so the process improves rather than repeating the same miss. In your answer, examine bias, outdated assumptions, timing, data quality, model logic, operational changes, and accountability. Explain how you would backtest, recalibrate drivers, document changes, and monitor forecast accuracy over time. Question 18. What financial risks might a diversified company like Cox face? A diversified company can face demand and pricing pressure, customer churn, technology obsolescence, cybersecurity incidents, regulatory changes, vendor concentration, and large capital requirements. I would quantify exposure through scenarios, sensitivity analysis, liquidity forecasts, and key risk indicators. For example, I would test how lower volume, higher costs, or delayed investment affects EBITDA and cash flow. An analyst's role is not to eliminate uncertainty, but to make it visible early and help decision-makers choose appropriate mitigations. Focus on demand, pricing, customer retention, technology and capital spending, cybersecurity, regulatory, liquidity, vendor, and execution risks. Explain how an analyst can quantify exposures, monitor indicators, and support mitigation. Question 19. How would you use data visualization in a management reporting package? I would begin with the management decision the package needs to support, then select only the metrics that explain performance or require action. A concise dashboard might show actual versus budget, trend, forecast, and key operating drivers, with clear annotations for unusual movements. I would use consistent definitions, restrained formatting, and drill down detail only where useful. Before distribution, I would reconcile displayed numbers to approved sources. Effective visualization helps leaders see the story quickly and ask better questions. Make sure to cover audience, decision objective, metric selection, hierarchy, trend and variance visuals, simple design, annotations, and data integrity. Emphasize that visualization should clarify a decision, not decorate a report. Question 20. What questions would you ask the hiring manager about this financial analyst role at Cox? I would ask which decisions this analyst most directly supports and how success is measured during the first 6 months. I would also ask about the planning calendar, reporting cadence, primary systems, and the balance between recurring analysis and project work. Understanding key stakeholders would help me anticipate collaboration needs. Finally, I would ask what the team is currently trying to improve, such as forecast accuracy or reporting automation. Those answers would help me contribute quickly and develop in the right direction. Be sure to ask about success measures, forecast and reporting cadence, systems, stakeholder relationships, team structure, development, and the role's most important business challenges. Choose questions that demonstrate preparation and genuine curiosity. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.